All right, folks, you might have noticed that we are in the heat of earnings season, and there is a clear pattern. The economy is slowing down, consumer spending is slowing down, and this is impacting corporate revenues negatively. But there are companies who are managing to mitigate this decline in revenues because of a loss in demand in certain cohort of the consumer by raising prices on other consumers who can still afford to pay. This is called the pricing power. And as an investor, you want to stick with companies that still have the pricing power. We're seeing the majority of these companies in healthcare, in consumer staples. For example, last week we got earnings from P&G, Procter & Gamble. And while sales were down all in all, they're not selling as much product as they used to. Yet somehow their sales number, their revenues, were actually up year on year. Well, how did that happen? They're raising prices. Sure, they're losing volume of sales, but they're making up for that by raising prices on those of us consumers who can still afford to pay, which is, by the way, a clear evidence of the stagflation that we have in the economy right now. We have a recessionary force with a lot of consumers slowing down because they lost their jobs or they're burdened by inflation. Their incomes are not matching. They might have maxed out their credit cards. And now the only option they got is slowing down in spending, cutting down on things that they don't need and sometimes things that they need but they can no longer afford. This is a recessionary force working out in the economy right now. On the other hand, you have companies continuing to raise prices higher. That's inflationary. The combination of both is stagflationary in this economy. And the problem becomes, what about companies that can no longer increase prices? They don't have the pricing power anymore. These are the kind of companies that are crashing right now. And among them, of course, one of the most important stocks, one of the most favorable stocks among the institutionals and the mom and pop crowds alike, Tesla, aka the souffle. And the souffle is getting crushed under a hammer. Why is this happening? They're losing the pricing power. And now we're finding out that perhaps Tesla, all of the hype that this is going to be the future and worth trillions of dollars, maybe all of this was just a mere overhype. And in reality, Tesla's just another car company. Well, we have to follow the story and look at the details. So let's do that. And folks, as always, I have a good one for you tonight. So let's dive right into it. And here it is in focus tonight. At the end of the day, it's a souffle getting crushed under a hammer. Last December was an absolute disastrous performance by Tesla stock. Matter of fact, for the entirety of the year, shares of Tesla went down by about 60%. And the short sellers netted about $15 billion from the collapse of Tesla stock. And in this channel, we warned investors about an upcoming sell-off in Tesla stock. Take a look. We have lower highs and lower lows. We have negative divergence on the RSI. We have a potential for a crossing in the MACD from a weekly perspective, indicating that the bullish momentum is over for Tesla. And if that is the case, and the chart goes all the way down to the lower range of the Mega Pine pattern, that would be a downside of over 50%. So Tesla longs, this is your last warning. And here's how it played out. Tesla went down significantly. And it was not just the short sellers who benefited. It was also the CEO himself, Elon Musk, who sold billions and billions and billions of dollars worth of Tesla shares last year. And the man warned about a worst-case scenario for the economy, that we are overdue for a recession. And therefore, he wanted to sell some shares to raise dry powder in case we have this worst case scenario. And of course, the sell-off was overdone. And a lot of investors, specifically in the mom and pop cohort, looked at the sell-off and the crash in Tesla stock as an opportunity to buy. Now, in this channel, we looked at it as an opportunity too. Not to buy for the long run, but to play an oversold rally. Take a look. The RSI continues to firm up in positive divergence. So is the MACD indicator. Yes, Tesla is facing some resistance here, the top of the range of the consolidation, but it could break out, and it could break out in a big way. And since then, we got a massive rally in Tesla stock. It is one of the best performers year to date. But the problem is there was so much indulgence in buying the stock that the worst is behind, not listening to the CEO himself, who warned of a worst-case scenario, that perhaps we will see a severe recession, and he was raising cash himself. Yet investors, as the rally was ongoing, dismissed all of these warnings and looked at the rally in Tesla as the beginning of a new bull run, and perhaps the worst is already behind us, and a recession will never happen, even though Elon Musk continued to warn. In turbulent economic times, he said, be wary of using margin loans to buy stocks. In other words, Elon Musk will not come out and say, hey folks, stop buying my stock. But he was perhaps concerned that a lot of investors were not taking precautionary measures in buying the stock, and perhaps using even margin in their bets. But of course, as the stock started to recover because of the stampede by the retail investor in buying the dip in Tesla, it did not take Elon Musk too long before starting to dump more shares of Tesla. And he proceeded to mock short sellers such as Michael Burry, so the sentiment was changing at the time, from being cautious to perhaps breathing a sigh of relief, combined with a little bit of arrogance. Yet the warning signs were clear. There was a fundamental problem with Tesla and many EV makers. The prices were too high for the consumer. Now, EV makers couldn't reduce prices by a lot because their input cost was increasing, be it from inflationary wages to input costs, or the rise in raw material costs, be it lithium, be it nickel, cobalt, all moving higher. There was a limitation for these companies in terms of price reduction to meet consumer demand. But of course, the Biden administration came to the rescue by using a lot of taxpayer money to subsidize the buying of EVs. But that was not enough to elicit more demand by the consumer, because the problem is, sure, the government can give tax rebates and subsidies to a certain amount, but what if the prices of input costs, specifically these commodities, continue to move higher? What is the solution of that? The majority of lithium we get comes from overseas. And the problem with that is the demand remains so high for the materials, for the lithium itself, from suppliers such as Tesla and other manufacturers, but not particularly from the consumer. This surge in demand by the manufacturers to plan ahead of time and hoard lithium in expectations of a surge in demand later on created a lot of demand pressure on these lithium, nickel, cobalt suppliers, and there was a mismatch between demand and supply, and therefore prices continued to move higher and higher and higher. And government subsidies for the consumer to buy EVs, that was not enough. And now the Biden administration had to target the resources themselves, the shortages in these resources, be it lithium, nickel, cobalt, even copper, by subsidizing the development of lithium mines, for example, in the United States, specifically in the state of Nevada. Because, blowing up a mountain, using an insane amount of water in a state that is already suffering from lack of water resources is considered green energy for some reason. But in any case, this is a long-term project, developing all of these lithium mines and increasing the supply. In the meantime, car manufacturers such as Tesla were suffering from increasing input costs, yet the demand slowing down despite the government subsidies. And Tesla resorted to price cuts. They had to cut prices not just one time, but repeatedly this year. And the plan began with slashing prices on higher-end models that were already suffering from lack of demand. We're talking about the Model X and Model S. Yet despite all of these price cuts, the demand did not increase dramatically. But then came the price cuts for the Model 3 and the Model Y, where the aggregate demand remains too hot. And of course, demand showed up, the aggregate demand showed up, and we saw a stampede in buying the Model 3 and the Model Y. Tesla slashed prices in China, slashed prices in the US and in the EU, and effectively launched a price war against all other electric vehicle manufacturers, be it Ford, GM, Chinese, European, or even Korean manufacturers. And there's a point in these price cuts. Let's see if you caught it or not, but we're going to go over it by the end of the video. Why did the price cuts in the Model X and Model S fail, while the price cuts in the Model S and Model Y succeeded, at least at the time? And of course, a lot of buyers said, wait a minute, we feel duped here. We bought right before the price cuts. Now the prices are cheaper by a lot. What's going on? And the reaction by Tesla was to raise prices again. But that did not work out. The demand problem was clear. The economy is slowing down, be it here, be it in China, be it in EU, be it all over the place. And the consumer is cutting down on big ticket spending. So Tesla continued to slash prices over and over and over and over again, fifth time and a sixth time, and now prices went down dramatically. For the Model 3, prices went down by 15%. For the Model Y, they went down by 29%. For the Model S, they went down by 19%. And for Model X, prices went down by 21%. And I will show you by the end of the video why these prices will go down by a lot, more than they already went down by. Another sign of trouble was Elon Musk going back to China to visit the Shanghai factory. And of course, the problem in China is A lot of the Chinese manufacturers, after years and years of hosting Tesla, they figured out how to compete with it at a better price, of course. And the most notable example is BYD. BYD is now exporting cars out of China after increasing their domestic market share dramatically at the expense of Tesla. Deliveries of BYD's cars were surging significantly higher, and the catalyst was China reopening out of the thing restrictions. But of course, as everything in this economy, perhaps the reopening of China story was an overhype, because BYD has better prices than Tesla, and their deliveries went down in Q1 of 23. That was yet another warning signal that even in the hottest market of EVs, and at more competitive prices by BYD, demand is still going down. And the story for Tesla gets even worse when we go back here in the US. California has always been the largest market share for Tesla, but now we see Tesla's market share tumbling as we see Korean manufacturers, Ford, GM, European manufacturers competing and stealing market share away from Tesla, and that is despite the aggressive price cuts by the company. Tesla controlled 59.6% of the battery electric market in California from January to March. Listen to this, down from 72.7% for all of 22. And this is the lowest market share since 2017. So it is absolutely insane for the market share of any company to go down from 73% to 60% in a matter of a year, actually less than a year. And it is no wonder why Tesla is now upping the ante in this price war. Elon Musk and Tesla say they're going to cut prices even more to gain back market share in California, in China, and other territories. And the question I want you to think about is, will the price cuts really help Tesla regain market share? Is it all about the pricing, or is it about the brand, or is it about something else? Why are consumers switching away from Tesla in California, for example? Is it just due to pricing? And will price cuts and destroying the margins of the company help regain market share or not? We'll go over the question again by the end of the video, but when it rains, it pours for the souffle. We also got a lot of class action lawsuits, be it the racial discrimination, be it the self-driving technology, or the latest being the lawsuit after allegations that workers secretly shared images from car cameras. And the warning signs continued to mount. We got a problem in this stock, and this is what we said about it in this channel. Take a look. Look at the daily chart. It appears that the MACD is losing momentum, and we have a trend line. The trend line has been broken. Whatever rebound the bulls get, these are dead cat bounces, relief rallies, and we're going to use them to short Tesla, and down it goes. And of course, now we know that Tesla went down big after earnings, but the warning signs were here. Among them, of course, the insider sale by the younger Musk, aka Fredo Musk, Kimball, who dumped $17 million worth of Tesla shares earlier this month, right before the report came out. But of course, the Tesla culties, who I love and adore, kept telling me, hey Maverick, this is a planned sale. It doesn't indicate anything at all. Just understand that when somebody files for selling their stock in any company, they can do that in December, in November, in any month, anytime they like, except certain blackout periods. But then they time the selling, so they can file in a certain date, but they can sell in another date. And the fact that Fredo decided to dump shares right before earnings was a red flag. I'd love to have the deal that he has. You sit in your ass all day, do nothing at all, and Big Brother does everything, and then you hit a button and you become rich based on his work. How come Fredo's not pitching in and helping Big Brother Elon in Twitter? If I was Elon, I'd cut him off. No more. And then, of course, came the moment of truth. Earnings came out for the company, and the results were abysmal. All of the warning signs were there, and here's the report. Of course, you can look at this and look at what the company is showing you, but you gotta develop trends. Because you can look at this report and say, okay, automotive revenues up 18% year on year. Expenses are actually down. These are not bad results at all. Sure, the net income is down 24% year on year, but what is the story behind that? And why is the stock reaction was so upsetting? Well, you have to develop a trend here. You have to see where the trend is heading, because this is a stock that is priced to perfection. This is a stock that is priced as a growth story. But if the growth story is damaged, then we have a big problem in this company, and of course a negative, oversized reaction in the stock. And of course we have all of this hype about AI and ChatGPT. Hey Maverick, sure a recession might happen, but AI will save us all. AI will cancel the recession. Just look at what ChatGPT is doing. Okay, so I asked ChatGPT, can you create a chart showing Tesla's automotive revenue growth rate since the first quarter of 21? And the AI All what it did is a simple Google search that I can do myself, showing me irrelevant info, and then told me to go myself. How rude, this AI. So I decided to do the job myself. Forget about AI. That's an overhype too. When we look at the automotive revenue growth year on year for Tesla, the trend is clear. We're talking about 18%, an impressive number on face value, yet when you pin it against the trend, it looks absolutely abysmal. We're talking about a company that about a year ago was reporting automotive revenue growth of 87% year on year. We're now down to 18%. When we look at the operating margin, which is my favorite ratio of all time, and it basically shows how much of each dollar the company generates in revenue from the operations alone, how much of that dollar is being kept as profit from the operations alone, pure operations, no taxes, no interest expense, no bullshit. The operating margin for Tesla is 11%, which is impressive against, let's say, GM or Ford. It is a high operating margin in the automotive business, but it looks less impressive if you look at the trend. Last quarter, the operating margin was 16%. Last year, same quarter, it was 19%, and in 21, it was 21%. So clearly, the company is less profitable than before. And then we look perhaps at the most alarming number that we got. How about pure revenues? Just plain vanilla revenues. Most companies are showing year-on-year growth in revenues. They should, theoretically speaking, but not in Tesla. Tesla is actually showing a slowdown in revenues sequentially, quarter over quarter, in a clear trend of a stall here. Since Q3 of 22, the company's revenues stalling and now trending down. We look at the gross profit trend. What do we see here? Similar story. The company is less profitable sequentially, quarter over quarter, and most importantly, year on year. And the problem here is, again, if the company is paying a top dollar, arm and a leg to secure battery supplies, to secure lithium, nickel, cobalt, copper, and higher wages, and then at the same time cut prices to meet demand by the consumer, we got a problem here. We got a company that is losing to this inflation, or perhaps the stagflationary environment in the economy. And perhaps now you know why Tesla's net income went down by more than 20% year on year. The trends all in all are negative. And then we have to look at the stock's valuation. What are we paying for these kind of results? We will look at the PE ratio, price, for earnings. What are you paying right now for last year's earnings? You're paying about 50 times what Tesla produced in earnings last year. When we look at the forward PE ratio, which is how much are you paying for this year's or next year's earnings, you're paying about 32 times. When we look at the price to sales ratio, what are you paying right now for the company's sales? The answer is you're paying about 6 times, which is too much for an automotive company. And folks, all in all, the price war initiated by Elon Musk and Tesla is a kamikaze move. It damages Tesla, but it damages other automobile manufacturers too. Be it GM, be it Ford, you can see clearly that automotive shares are lagging the S&P 500. Automotives in white, the S&P in blue. It is clear that automotives right now are not investable. This price war will be among many to come until the final formation of the market share of each company in each market is already finalized. And this is going to be a process that takes years and years. And of course, Tesla's hoping that in the long run, they will emerge victorious. But history says that any company involved in a price war is uninvestable. And in summary, folks, what is the problem with Tesla here? And I'm not going to go the media's route of, oh, Elon is being distracted by Twitter, he lost his mind, yada, yada, yada. I think Elon has proven that he can multitask. He can lead multiple companies just fine. Is Elon a nuisance? Sure, but he's not the core problem with what's going on in Tesla. I think we can summarize Tesla's problems as number one, cannibalization. What am I talking about? I've been a critic of keeping the Model X and Model S alive. I used to own the Model S. It was okay at best, but it certainly doesn't stand against the competition right now. But the cannibalization happened the moment the Model 3 was announced. And clearly, the Model 3 was superior in many aspects over the Model S, which is more expensive. So it was a no-brainer. Why would I buy the Model S when I can buy the Model 3? And hence the cannibalization effect. And it comes to a question of efficiency. Is it really worth it to keep these models on? I've been calling, hey, Tesla, Elon Musk, cancel Model S and Model X and concentrate on Model 3 and Model Y. And the results from Tesla prove my point. Look at the year-on-year growth in the production of Model S and Model X, up 37%, but deliveries are down by 27%. There is a major gap opening here. In other words, Tesla is having a problem of oversupply in the Model S and Model X. Go back to Q1 of 22. The company produced about 14,218 Model S and Model X, and they delivered about 14,724 vehicles of these models. In other words, you see the deliveries matching the rate of production or exceeding. But then the problem started to appear in Q3 of 22, when production exceeded deliveries in the Model S and Model X. And we're not talking about, just by 2,000 vehicles. We're talking about in Q1 23, 19,437 cars of the Model S and Model X were produced, but only 10,695 vehicles were delivered. In other words, this is bad for the company. They have an oversupply problem, but good news for the consumer who's been waiting to buy Model S or Model X. You're going to get a steep discount for these soufflés. They might even hand them for free. And then the second problem for Tesla is the lack of identity. Is this car a luxury car brand? Is it a value brand? What is it? What is Tesla? In the past, it was okay to have no identity at all because there was no competition at all. Now we have every manufacturer producing EVs. And we know that by promoting and concentrating on the Model 3, Tesla lost the upper class war, which means the luxury brand war. They have the Model S and Model X, but these two lose big time to Mercedes, to BMW, to Audi. The Germans absolutely destroyed Tesla, which supports my recommendation that the company has to scrap the Model S and Model X altogether. And that leaves Tesla as what? The mid-class sedan, the Camry of EVs. That is a dangerous place to be. And the reason is, even look at Camry or Honda Accord, the mid-class sedan. So many companies attempted to compete with Camry and Accord and they failed. The Ford Taurus, the Chevy Malibu, even the German manufacturers, the VW Passat, all failed. Even the Mazda 6, which I used to own one, also failed. It was a great vehicle, but it doesn't compare to the Camry or the Accord. And it took these two brands, Toyota Camry and Honda Accord, a long time to establish their dominance in this class and split the market pretty much 50-50. If Tesla remains as the mid-class sedan of EVs, they risk the problem of a competitor such as Toyota or Honda or be it whatever manufacturer you want to fill in. Developing a competitive brand, a competitive vehicle, it could be the Mustang EV, and then splitting the market with Tesla. And this outcome limits the growth of the company. It doesn't become a growth company anymore. And therefore, now Tesla has to compete on the value prospect. They want to compete with the Chevy Volt. They want to compete with the Chinese manufacturers. And therefore, Elon Musk is being aggressive with price cuts. The problem is, if Tesla goes down this route, it dilutes the value of the brand. Not to mention, of course, it destroys margins because these value manufacturers, they have lower input cost compared to Tesla. How much pain would Tesla have to endure to scare all of these manufacturers out of the market? And would it be worth it at the end of the day? Is it going to work as a strategy? Because Tesla's plan right now, let's lower prices as much as possible to destroy the Chevys and the GMs, the Fords, and even some Chinese manufacturers from competing with Tesla, and then raise prices again and dominate the mid-class sedan class. What if the value brands prove to be more resilient against the competition? Then Tesla's just wasting time and money. So the lack of identity by the brand is a major problem. And the third and a major problem is the bullwhip impact. The overproduction. Tesla received a lot of feedback from 2020 and 21. The demand was surging higher and they had to respond. Tesla built factories in Berlin, in Shanghai, in Texas to meet this demand, and they overproduced vehicles. I don't know if you caught it or not, but if we go back to the slide of deliveries versus production, look at the Model 3. Forget about the S and X. Look at the 3 and Ys. Even in this category, we see the rate of production exceeding the rate of deliveries. So there is a problem here in oversupply. And of course, the problem got exacerbated by the technology companies' layoffs. A lot of buyers of Tesla cars happen to be in tech. A lot of them lost jobs. They need to reduce spending, and now we have a problem with oversupply even in the Model 3. Number 4, when we talk about Tesla's problems, how about cost management? They can do certain things, but they cannot have a magic wand and create lithium, for example, or nickel, or cobalt, or copper. So they have limitation in controlling all of these costs. They can't lower wages right now, which means they're going to have to take the route of technology companies of more and more layoffs. That's number one. Number two, what they can do once again is scrapping the production of the Model S and the Model X entirely. They lost this class anyways. It is now dominated by German manufacturers. What is the point? Cut the costs. It's going to take a little bit of pain, but a year, 2 years from now, the company will be more efficient. And the last problem is the soufflés are really ugly. I'm sorry. I know it's your baby. Nobody wants their babies to be called ugly, but the cars are ugly. They need a facelift that could induce more demand. People who are loyal to Tesla need a refresher. You need an upgrade cycle because frankly speaking, you go over any street in America, you go to any mall or parking lot, or even in Uber and Lyft drivers, they all got Teslas. Teslas all over the place. They look the same. They look the same for a long time. It is a time for a facelift. But folks, if all of this analysis is not to your satisfaction, if you think that the Maverick of Wall Street is just a perma-bear and he doesn't understand the prospects of Tesla moving all the way to $15 million a share because of AI, because of robotaxis, because of the solar diapers, whatever, rest assured you got Mama Cathy Wood, who now thinks that robotaxi boom will boost Tesla stock to 2,000 within 5 years. So there you go. And with that, folks, this is the conclusion of this video. If you happen to be a member of this channel, we got technical analysis for the stock market coming up, along with market commentary. We're going to brush over the Biden re-election and some of the events that took place in the market today. But if you're not, then rest assured, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Take care.
I was asked politely to retire. So here I am, enjoying my retirement.